We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Henrik Zeberg, macroeconomist, business cycle student, Elliot Wave practitioner, and the co-founder of the ZebergReport.com. Thanks for joining me today, Henrik.
Thank you, Tom. Thank you for having me.
So why don't we start by getting your 5,000-foot view of the markets? There seems to be so many things to pay attention to, but what are the main pieces of the puzzle that you watch and really inform your feel for where we are in some of the cycles that are playing out?
Okay, that sounds like a great way to start. So really just if you take it from the 40,000 feet kind of a perspective, I'm seeing a blow off top that not too many people seem to share the perspective of these days, which will unfold into mid-summer of this year. Then I see this deflationary bust that I've been speaking of, which will take everything down, and especially also gold that I've been speaking of for quite some time. It's been a long journey, but we're getting there. We will get there. And really that the crash that we're going to see both with the deflationary part and then with the stagflation we're going to see also play out at a later stage is going to be quite devastating for the markets. And I see 75-80% declines in some of the indices. So it's quite devastating and something you have to compare to the 1929 kind of scenario.
Mm-hmm. Yeah, and a lot of people, let's say, maybe misinterpret or don't listen to your whole perspective. And that's why I wanted to have you back again to kind of balance out the view, because I don't think it's always good to be completely bullish on everything all the time, no matter what asset class it is, whether that's something that a lot of our listeners love, like gold. I like to kind of be able to try and balance that out by getting different perspectives. So I appreciate you showing us, your perspective and where you think things are headed. So how do these cycles form? Are all these trading activities in aggregate just a composition of the human emotion that can be predicted in some ways?
Well, that's how I perceive things. I think that it's kind of naive if you look watch the news and you hear, okay, so the market today fell because this and that, something that they pulled out of the news and said, okay, this is kind of event and that's going to crash the dollar or something like that. Obviously, there are major news that's coming out which will change direction or at least affect markets and affect certain assets in certain ways. But if you look at the explanatory variables or the variables behind the Dixie, for instance, the dollar, there are thousands of things that are influencing that. So I think that just looking at one or two or three, a fundamental analysis will always be a partial analysis. Whereas if you look at the price structures is actually taking in all the information that you get from everywhere, from sources we don't even know of. So that's why I think when you look into trillions of trades, which forms these price structures, that's really when you will see patterns emerge, and the patterns are the ones that we need to look for, because we cannot forecast on anything, any black swans, any things like that. But we can see that if this happens, other times before that, when we saw that, that's going to play out something like this. And people have no issues in looking at shoulder head shoulders patterns and say, oh, this is a shoulder head shoulder, and that's everybody jumps on that, and that's based on the same narrative, the same foundation, that because we've seen this before, because the structures are like that. So I just take that a step further, and the Elliot Wave perspective is simply just to say, actually, you got a bullish development, you got a bearish development, but something is impulsive waves and some of them are correctional waves. I mean, you can start by understanding where you see the correctional waves, which are the most fascinating, and also where you can actually see, okay, this is just a correction on something of a bigger blow. Well, then you end up in a contrarian camp where I find myself very often, not that I want to, but it's kind of lonely here, but that's how I perceive things.
Mm-hmm. So, thinking about the idea of trillions of trades and let's say the human emotion aspect of it, and then we add in the advent of the high frequency trading algorithms, does that, change things in some way or affect your analysis?
first of all, the algorithms are programmed by humans. Mm-hmm. And what they do also, machine learning, I also work within machine learning. What they do is that they watch the market and learn from the market, which is based on other, on people, on humans. Mm-hmm. So we can say that it's not that they come with some kind of artificial intelligence, which is, unlike the humans or anything like that. It's actually just an extended arm of the human being. So algorithms are based on human emotions, just like human emotions are. So all these traits will come down back to the curve of us being over pessimistic, then becoming over optimistic, and then we go all the way through the cycle. And if you look through that, and you add up, thousands of that, you start to get the patterns. And the patterns can then be, looked at in a longer perspective. So if you take a bullish move, you'll see, okay, the first part is where the people that actually see this get in the first, and nobody understands that. Nobody sees why is that? The Dixie, bottoming out in January last year. Why should it bottom out? It's printing. They're printing so much money. Why should it be? Somebody gets in at the right time. Then it pulls back a little, and then the move starts that gets everybody in. It gets over enthusiastic about what's happening, and then at some point it says, okay, we went a little too far. It kind of consolidates and it blows into the final top where the right people then gets out again. So these are the structures of the Elliot Wave, and that's, you can like them or not, but you are actually, you see a lot of people who dislike it, and they will actually utilize it. What I do see, though, is that a lot of people are misusing Elliot Waves, because they are taking a 1 hour chart or something like that, or even a daily chart, just say, okay, this is the wave, this is 1, 2, 3, 4, 5, and then they say, so how can you say this? See, this is not how I work with it. So I got 100 or hundreds of charts where I fit them all in where we are in the macro cycle. And that means that if you see commodities go up and you see the dollar go up, something has to give. It's not like there's 100% correlation between a negative correlation between that, but something has to give at a certain point. Mm-hmm. And that's where the count starts to add it. You can start to add that in. And if you start to do that and you get the major turning point, you can actually, add that all together as a major puzzle and say, this seems to be the most, plausible way, the probable path for where we're going. And my famous or infamous, whatever, gold call is based on simply saying, well, we had a blowout, we had a strong top in 2011, and then we've seen something which was a correction. And then the move from 2015 up again seemed also to be a correction. And if you take that in, well, actually, in the Elliott Wave tells us we got, another dip down. And if we take a look at that, it's actually going to be a quite big one. Where should that come from? I didn't know at that point. Now it seems like we are. I said, I can only envision, and that's been my thesis for years, that we're going to see a major, major deflationary bust. And I hope I also said that on your last show. I think I did. Because it hasn't changed for years, because I see that we're going to get into that major deflationary bust. And then people will ask me now, why do you see the deflationary bust? Because right now everything is, we're seeing this inflation come out. And actually that's the case. I mean, that's actually what's going to build, the case for the deflationary bust. Because if you look at supply and demand, and this is where I see inflation come from. People say it comes from money printing alone. Well, there is a case of that, but there is the biggest case is actually from a mismatch between demand and supply. And if you look at that, and you look at the numbers of freight tanker ships around the world that's been been anchoring outside of ports, not being able to unload or whatever, these are the signs of a supply chain that is not working. But where there is a demand, there is a supply. And the problem we did with the COVID crisis, the administrations did during the COVID crisis, was that they saw this as a major demand shock to the economy. And well, there was a little of a shock, but they went in like massive. It was larger like the Marshall age just after the Second World War. This was what we pushed into the economy. So how can it that we do not understand that? Of course, we're going to see some kind of inflationary spike on that. But everybody who's been driving been running a business or been close to a business will know that if you see a demand that is increasing with this kind of amount, what do you do? You invest, you build capacity, you get ready for it because you're doing great. You're doing a fantastic job in running your business. So everybody's building capacity, everybody's building supply. Now, the stimulus is wearing out at some point. and it's not going. You're not going to buy that third car, the fourth car. You spend some extra money because of the stimulus. You pull that demand forward. You pull the investment forward. If the demand then tops, and everybody's been building supplies for 2 years or something like that or more, well, then you got the perfect situation for a bust, because you still at the same time you get a very hawkish Fed coming out saying, oh, we are afraid of what our own ghost here. We got the genie out the bottle. We wanted inflation, but we didn't want this much. And then boom, they're going right. And they're actually going to accelerate that bust, because they're going to say, okay, we're going to hike rates at a fast pace. Mm-hmm. So that's why the ingredients for the deflationary bust seems to be more there now than they were just a year ago. And this inflationary spike that we've had is going to be reversed. And I can't understand people think it's going to last, because we have so much evidence that it's based on demand and supply. And that's where we're going to see it. So the case for the deflationary bust is still there, and I think we're going to be quite surprised to see where that's going to take us. To be honest.
Mm-hmm. So when part of your work is also based on the Kondratieff cycles, and you and I were kind of talking before the interview here that I kind of made the point that, since the last time we spoke, who could have possibly seen the conflict in Russia and Ukraine? But, as part of the Kondratieff Winter, you said that conflict ends up being part of that, the symptoms of that, let's say, down part of the cycle. So explain to us a bit more about the Kondratieff cycles and what the winter part means.
Yeah, sure. But let me share a chart or two here. I just think I have something that I could just, so if I do let's see this, yeah, we go. Now this one then, let's move right on to this chart right here. So what we got here is actually from a tweet I did, I think 3 or 4 years ago. And where I said, we are in the winter phase. And what is the winter phase? I mean, Kondratieff was this unfortunate economist that Stalin put in place to predict why capitalism was going to fail. He wasn't able to do that. He came back and he kind of set up this model here, not precisely as it is today. And it's not a precise model, but it kind of gives you the seasonalities, which I like, that there are periods of time where everything in the environment, the economic environment, is set for growth, or there is times where we've simply been building too much debt and it's weighing heavily on the societies. We don't see that, because when we stand on the face of the earth, we do not see that it's actually a round planet that we're on and not a flat one. So we don't feel it on a daily basis. But the fact is that in a larger perspective, we have now built up huge amounts of debt through that autumn phase, which we were in until late 1990s. And then we entered the winter phase, where the deflationary pressure from the debt buildup that we have had is playing in. And what we then see is that, okay, so you got some crisis coming out, because the Fed and the central banks were trying to stimulate, and we have seen this before. We're not in a new world. We have seen paper printing or money printing before, and during the French Revolution or before that. So what is happening is that you see that we're trying to stimulate in an easy way, and the money printing comes up, or first it was getting the rates, forcing the rates lower. But when you do that, you actually put more risk into the system, because when you force the rates lower, you're inviting people in to do risky investments. So when the risk, the rate goes from 5 to 2%, or actually to 1%, which we did just after the 9/11, right? Well, people are saying, oh my God, we got to buy an apartment. It's almost for free. You can, why don't we buy 3 or 4 of them? And boom, you got that one. Okay, so we get back out again. And then we say, we need to do it even bigger this time. We blow something up, bigger bazooka is needed. And then we do it one more time. And then there's somebody, fantastic central banker comes up with the idea, why don't we just print the money? I mean, it's simpler, because we can, lower to the minus, get negative rates, because then people will start to pull out their money from the banks, and okay, we print the money and we start pushing them into, and we hope that there'll be this wealth effect from it. So the people, the things that should come out from a wealth effect, that people start to spend more money, and it's in the nature of people. Again, it's back to the cycles of it. We do the same mistakes all over. So that's why I think that the Kondratieff is worth studying. And what we see now is that the effects of this, that we're trying to squeeze the last kind of growth, economic growth out of a long overdue debt cycle. That is and we're doing that by, we just need to get the Keynesian stimulus working. So if we push some more money into it, eventually we'll get the positive spiral going up. Well, what they get is that they get more risk level put into the system. They get more bubbles blowing up. And I see it all over the place. I know there's a lot of people talking about crypto as a fantastic thing. And we talk about NFTs now, which is an even more fantastic, invention. What I say is that these are the kind of things you would see in a speculative environment. And these are, extremely speculative because they got zero yields on it. So it's extremely speculative. So why am I long sushi right now? Well, I am, because I will tell you later, because I think we're going to have a blow off top in this. But do I expect it to hold it in 5 or 10 years? No way, because I know it's worthless, but I think people are going to jump into it. And that's why it's a very speculative, position that I hold. So the winter is this where we create this bubble environment, bubble economics. And I think we haven't seen the last of it. And why is that? Because we haven't seen the last of the speculative behavior, and we haven't seen our rates, as I see it, reach the long-term bottom that I expect. We haven't seen pension fund crisis that I expect. We haven't seen the full currency crisis that I expect when the dollar blows above 105 or even 110. So there are still some events that I expect to unfold, and I expect also to see a dollar that will be trashed by the Fed at some point when it starts. These days, it's not too hard to talk about it. 2 years ago, when I talked about this, is that the dollar is going to be strong. People were, no, well, they won't allow that. It won't get there. Mm-hmm. And now we are here with the dollars actually being strong. So I think that the winter has got more in us, in waiting for us. So we will see that. And unfortunately, one of the things that I put into this chart here was war. And war is something that, well, if you have, an internal situation, China is maybe a good example here. So you got an economy that is also stalling because of the debt situation and because of the, saturation of how, debt saturated the whole economy has become. And then you need to find something, okay, how can we actually get the attention away from that? The economy is stalling and people should look somewhere else. And then that's where we find an outer enemy often. Or we blame countries around us for trade kind of situation or whatever it is that was going on between the US and China. So of course that's not the war we see right now, but that's the war that could be in waiting also, unfortunately, if we look to the Taiwanese situation also. So right now it's in Russia and it's in Ukraine, and but it was something I'm not saying that the Ukrainian-Russian war has something to do necessarily with this kind of setup, but mm-hmm. I like the thinking behind it, and that's why I had that also on this chart.
Yeah, absolutely. And you were mentioning to me that really the dollar is king. It is the piece of this that is going to drive all of it. So why don't you give us some perspective on where you see the dollar, where we are now and where we're headed?
Sure. So I've had this chart for a very, very long time, and I think I haven't changed. Of course, it is not exactly as I see it play out, but I saw when we got back here in 2008, we saw the start of money printing, and then actually the bull market started from there. And that was so the way I look at things, it is actually a correction in the market because, as we all know, in the very long time frame, the DXY has been going lower. If you go back, so the Swiss franc and others have been strengthening against the dollars. That's what we see here into 2008. So what we have seen since 2008 is actually part of a larger correctional picture that is going to take us up to around this top that we had back here in 2000, 2001, as I see it. And the path for that is, it's going to be an A, B, and a C in the very long. We are right now in an A wave, and that's as I see it. So this has been a 1, 2, 3, and then a fourth wave back here, and this is back in January of 21, where it just hit that, and the sentiment was really low, and I said I think that's the bottom, and then boom, we went higher here. So I think we're now going to this level here. We're going up and revisit this, this top of this trend line here. And that gives us a perspective of 111, 117, 120 even, because I can make it a throw over. I can see it from my own picture here. So if I pull that away, so 111 is just the extension to it, but it could easily be just also do a throw over here. So 116 or 20 even, or something like that. So it could be quite severe. So that's where we're going, and that's where I say that's the deflationary bust. Because when the dollar is starting to get that strong, it will be very harmful for the economies, for the emerging market, and everything else. And we start to feel the effects of that right now. But it rallies in one straight line. And a move from a 4 to the 5th here is going to have another correctional move. And that's going to be a third wave, fourth wave, which I think will take us down to around 94. So I think we're going to see quite a strong push down in the dollar. And the FOMC next week may be a good time for that. I noticed that we have now the sentiment is at 95 yesterday. I think it's even higher today after we had 103 now here on the Dixie. So of course there's a lot of bullishness now among traders, but I think it's going to take a breather. It won't be a reversal here. It will be a breather, and that's where we're going to see the next move come. But that breather here, and this is where the timing comes in, that will be an A, B, and a C kind of move down to a fourth wave, will be where I think we're going to see a lot of, we're going to see that final blow off top in equities set in. Because if you look at it, what do we got right now? We got a lot of negative, bearishness in the market. But I actually got a kind of, a certain set of, I got some arguments I got some, what I call the pieces of evidence for why we're not in a crash right now. And I could take you through that in just a while here, but just answering your question, I think we're going to go down to the dollar, and then I think we're going to go up really strongly in that fifth wave, and that will be the deflationary part of it. But first, a blow off top, and then a strong deflationary bust into the later stages of this year, into early stage 23. And at some point, you'll then see that the Fed will reverse, and you'll also see that the administration will probably do something of what I heard, at least I saw that this morning on Twitter, that Biden comes out and say, maybe we're going to cancel all student debt. And this is the one thing, if we go back to the Kondratieff thinking again, what Kondratieff is saying is the debt-saturated economy needs to get, a relief. And the only way you do that is by taking away some of that, taking away the debt. So forgiveness, like what was talked about here, restructuring, defaults, whatever, but we need the debt levels to get down, to get to that situation we had back after the Second World War, where you actually had also a very indebted world, and you then had the Bretton Woods, you got out of that, and then the world could start to grow again. And this is what I think this time around we'll see again. We need to get the debt levels down, but that will of course be inflationary, and that's why I think there's going to be a time of strong inflation and a new inflationary regime coming up. Again, that's further down the line. So, but for now, for the next 2-3 months, it's going to be about the bounce before the deflationary bust, which we're the top in the stock market later this year.
So into that blow off top, is that really, or what do you think that is going to be driven by? Is that just going to create a more risk on environment that people just feed into?
Yes, because that's what's happening. That's what's happening is here. I mean, I can tell you that how much heat I got on Twitter when I was saying, okay, I think the dollar bottomed here. So no way, it's crashing, and everybody's printing it. Right now, we got the same kind of talk across Twitter and everywhere that because of the economy and we are not in a good place, and everybody can see the war and inflation, and everybody can mention all that. But if you take the pieces of evidence and say, are we in a crash? Because if we are in a crash right now, on NASDAQ, it started in November. So there are a few pieces of evidence we could take a look at and then say, okay, if we are in a crash, we're probably also in a recession. So if we look at that and we can then conclude, oh, it doesn't look like that, then probably we're not in there. And then the Elliot Wave suggestion that we are just in the correctional move before the next top is what I believe in. And if it's okay with you, Tom, we can go through those evidence. I actually want to show why I think we are not in that crash, something that I showed to the subscribers on the Zeberg report.
Yeah, absolutely.
Okay, so let's do that then. Let me just see. So this is the report from Sunday, and I call it elementary, my dear Dr. Watson. First of all, if we look at a broader index, so people tend to look into, okay, let's look at the NASDAQ. Right? Okay, it broke this level, and oh my God, we're crashing, and everybody runs away. No, what we see here is actually, if we take the low from the March 2020, and we observe that in a larger perspective, well, yes, it is a bull market. It's a strong bull market. It's been moving up higher than the level we have to all-time highs. That means in an Elliot Wave perspective, we need to have 5 waves. I can only count 4 until this point here. What we then saw in this, and this is the world market ETF, MSCI. So yes, we then moved higher from the March low, and we have then seen some kind of move down here, which is what I call the deceiving wave 2, that we think, oh, the crash is now continuing. This is to the top, and now we crash. I say this is probably the second wave that we see, and we are then to see the next waves, moving up into that final high. That's a hypothesis for now, but we are at least not at all. We're not, reached down to the low here on the world ETF, which was from February and March. Actually, it was on the day of the invasion that was the low, and there are several actually bullish indicators to this one. That this point here is the highest point. And that's a correctional wave. That means that it's actually probably going to be a strong move up. So I'm just saying here on the world market ETF, there's not evidence that we are in a crash. There is evidence that we have been in a correctional move, and it seems like there's another move up. I hypothesize that this is a second wave. That's only speculation, you can say. But if we then look at the VIX and then say, okay, so when we had the crash in 2020, the VIX took off, and this is called LVO. The VIX took off immediately, within the day almost. See, if the crash has been going on since November or January to some people, who has forgotten to send the memo to the VIX that we're actually in a crash? So it's not blowing up, it's not moving up. Actually, it's been moving down since then. And it moves down like this, down to the side, a little up, down. And I think there's another move to the downside. That's my speculation. But at least I can still say as a fact that if the market top was in November, somebody forgot to tell the VIX, and we are now in April, almost May. So I'm saying this is an indication we are not in a crash. If I then look to what's happening in the yields, well, what we see in yields is that we have a spike in yields when we go into the crisis. And that's because the yield is a lagging indicator on the economy and saying, okay, so the economy was moving up really fast after the extreme stimulus coming out. And then it breaks something in the economy as it moves up. At some point, the debt levels, the debt saturation is not able to carry that kind of yield anymore. And that's when you see the reversal. So we see that top in yields before the recession. We see it before the recession, and it moves down during the recession. We saw it before the recession, and then they blow everything into it. So remember this short recession. It wasn't actually a real recession. It was 2 months. So, and then they blew it up one more time. So what I'm saying is that we are now getting closer to this point here of a top in yields. But if we were in a crash, we would also, and we were in a recession, you would have seen yields coming down. And then people say, this time is different. I say, no, that I don't believe. This time will be the same. Mm-hmm. So there will be a run so this is also another. So if we take also that to the next point, saying, okay, let's look at the SPX TLT ratio. So offensive positioning versus defensive. Are you in stocks or are you in TLT? This ratio gave us a nice top here in July of 2007. And the SPX topped in October, so 3 months before. It topped in January here, 1 month before. But what it did this time around, it had made a new high in April. Strange that we see that everybody calls for a crash since November or January, but this ratio makes a new. That means that people have not been positioning in TLT, and actually the TLT has still been underperforming. So you're not in an environment of a crash. So that's the next piece of evidence. And we have to piece them all together and say, what are then the most probable, outcome of this?
So that kind of shows us that this risk on environment is really intact, right?
And there's just bad times for it and good times for it. And then you got correctional moves that are deeper than others. But of course, but the real thing will be: are we going to see, before the deflationary bust, which I expect, are we going to see a risk on? And with this kind of environment we have right here, I can't say, okay, these kind of pieces of evidence tells me that we have seen the top. I can't say that. And if you also look at the sentiments, well, sentiment here 92, 75, and we did have a nice, strong, high one here, but we already down to 10, 18 on the sentiments, and people are calling for larger, declines here. Well, these have, certainly been areas where you should buy, the stock market. And if you then again piece it together with the other things that we said, and as the Elliot Wave tells me, there's probably one more, move up in this market. Well, I just, adding to the pieces of evidence here. And then if we go further on and say, okay, but are we in a recession then? I mean, if the stock market topped in November or in January, well, remember last time in 2007, we had the recession starting in December, the stock market topped in October. So I would think that the PMI should also kind of, like it did here, tell us that we are getting very close to a recession. I'm not saying we're not going to have one, because we're going to have a major one, but I don't think we're there yet. We can still be months out. So this is another piece of evidence. We're not in recession yet. And this piece here actually tells us we are not. Because if you look at the advanced monthly retail survey, trade survey, so during a recession, you will see a major decline in consumption and retail sales, and it'll start to decline. This was the top in November of 2007, a month before the recession set in. This was in February of 2020, decline. See, it made a new high in March. So if we also add that in, the consumption has not really, dropped like it should do. So we are not in recession either. I mean, at least that's the most probable explanation to what we see here. And if you then go on further and say, okay, what we normally see when we start to move up and we go out, we see this, what I call a deceiving wave 2, that it pulls back. And that is what I think we have seen in the SPX and in the Dow Jones, industrial average, at least. I don't know how much it's moving down today, and I could see another kind of pattern. But sometimes we have, even when the bull market started, you have pullbacks. You have this wave 2 that gives the investors, oh my God, we're going down again. I think there's a good chance that actually the outbreak of the war was the low in certain indices, and we're going higher from here. Mm-hmm. And yet we have people calling for a major top, and that I can't understand that we have seen this. So this is why I'm saying I think there's a blow-off top. I think there's going to be a blow-off top, and I got other pieces of evidence also saying actually it seems like growth stocks and value stocks is going to do quite well. So Cathie Woods, and I'm not a fan, is probably going to be right at least to a certain degree. Mm-hmm. So this is the kind of evidence I'd like to pull together.
Henrik, can we go back to the last chart for a second and look at the consumption? I just wanted to ask you if part of that is maybe driven by some of the inflation that we've seen, let's say in fuel and food, if those prices moving up could help drive that to that top that we saw.
Well, yeah, of course there can be some certain explanations like that. But still, also when you see a bust, you'll see that the economy pulls together. It's a deflating kind of thing. So where the economy, when money is going into the system, well, it inflates, and then when it starts to come out of the system, then the bust is setting in. So yes, of course, there can be a certain degree of that, but I just don't think we'll see that the consumption and retail sales is going to stay high and continue to put in new highs if we were in a recession. I think we're going to see something similar to what we've seen, other times before. And that's where I struggle with this, that people are saying, okay, we are in that. I can see that, numbers are not looking good, but they weren't looking great either in, early of 2007. And you had the top was in October. And that's not just what I'm saying. I say a blow off top that can really, that can be of an extreme magnitude because of the risk risk on kind of a sentiment that's going to set in with people and say, oh my God, it's all over, and we need to get in, and we need to get that over bullishness on risk assets before it really tops out. Mm-hmm. I don't think it does that with the kind of whimper we've seen during November, and then that was the top. I think it's because we're in the final phases of something, and that's the C wave in the Elliot Wave, and that's where people are saying, okay, this is it, and then they get positioned wrongly, and you can see that on the sentiment. So yeah, of course, we need to take to look at these numbers always and interpret them correctly. But if you piece the these pieces together, I get the most probable conclusion to me is we're not in a recession, we're not in a crash, we are in the fourth wave correction, but there's going to be another move up, and it's going to bring all people in just before the real top, and then the crash is going to start.
So what do you think, Henrik, this the blow off top is going to be driven by? Do you think that the Fed comes back in and rescues the markets from the decline that we've seen for the past week? Like what do you think drives that last part of the blow off top?
So first of all, there's never one thing just but there's always a few things that we need to look into, and one thing in a liquidity driven market, it will be of course the liquidity that will need to come back into the market. And right now it's been drained to a certain degree, at least there's a risk of it, and there's also some drainage going on. But right now, if you look at the China credit impulse and you see how they moved in again in March, you see actually you had a huge jump in that in March. They're stimulating, like crazy right now. So you got an easing going on in China. You got a potential top in the dollar coming out soon. If I'm right in what I said just before, mm-hmm. You potentially could see the top, setting in really soon on the DIX, at least a temporary top. And I'm just talking from the 103 or wherever it's going to top out to 94-ish on the Dixie, which will be felt. That will be that's a stimulus, a tailwind kind of thing. Mm-hmm. And I think we're seeing the top in rates as well. And if you pull those three things together, then you have the stimulus from China, you got the TLT or the rates top, and you've got the Dixie maybe correcting. Then you got the kind of ingredients you want from a liquidity driven point of view. Mm-hmm. And then everybody is expecting the Fed to be very, very hawkish, but and they will probably be hawkish. But there's again the expectation maybe here, and the Fed where are they going to put themselves in? And if they're going to be a little dovish on this, and we have these other factors in, then we could see something like this starting to develop. And then it will, by the end of it, again back to the Elliot Wave. First part, who sees it? Am I one of those that sees it right now? And then I'm being part of the first wave, pull back, and then you got the, oh my God, this is going to take off again. I need to get in, and I throw in all my pension fund money and all that, and then boom, it reaches the top at some point. So I think it's going to be risk on driven, and for a short amount of time. I just see the signs in a lot of the risk assets, also in cryptos, that they could have this amazing run one final time before we see the deflationary bust.
Mm-hmm. So as part of that deflationary bust, does everything basically get taken out, or is there any, let's say, safe haven?
Well, the safe haven will be for a certain amount of time the dollar. So when the dollar hits 94, and if it does that in that correctional, I mean, that's probably a good time to get very long the dollar for a certain amount for some time. Mm-hmm. And that would be the only thing I would hold. So something that was maybe even leverage the positioning dollar, and then TLTs. TLT is also it was down at, the sentiment was down at 5 the other week. It's just moved up a bit now. And I'm long that as well, and I'm expecting that to do tremendously well over the next coming weeks and months into that after the blow up. We'll actually start before, because it will also be part of that tailwind to the stocks. And then people will say, yeah, but can't bonds and stocks go up together? They can easily do that. They've done that many times, so that correlation doesn't spoil anything. But TLTs and dollars, that's what I will call in the deflationary. But remember, it's not only going to be like years. It's going to be a short, liquid phase where the dollar, like what we're kind of feeling right now, it's, where would you have wanted to spend put your money 3 months ago? I told my subscribers, dollars were a good thing to hold. I also said it's a good thing to start building TLTs. They have been moving down. Well, I'm not too, afraid of those, but because I think they'll do tremendously well soon. But you want to hold dollars, you want to hold TLTs. You do not want to hold any kind of risk assets. So I'm not this where the bubble is so big, and if you just take a look at that, we all know this, the Buffett indicator, or the this kind of similarities to that, but the Wilshire 5,000 to GDP ratio. I mean, we all know 2000 was a major bubble, 2007 was a major bubble, and we know that 1929 was at the similar height of the 2007, and we are up here today. So of course we are in a bubble, and where do we want to put our money if we are in a bubble like that? You do not want to have any negatives. But there will be an amount of time where you see that the economy is being deflated at some point, and people say, well, the Fed will jump in. Yes, they will. The Fed will jump in back in again, like what we've seen before, and there will be some packages coming out, and they're probably also going to forgive some student debt and whatever, and other kind of packages. And they will of course try to blow it off again. What I think they're going to unleash the next time, they're going to unleash real stagflation, not what some people are talking about now, but real stagflation. And that's going to make it all worse for a lot of risk assets. So at that point, I will be long gold miners. I'll be long silver and gold at that point. But that point is 8 months down the road, something like that.
Mm-hmm. So that's the next point I kind of wanted to move on to, is like when we or what you see the road ahead for, let's say, gold and silver are from here. Everything basically gets hit in that deflationary crash, including gold. Yeah,
I think my view on that. Let me just pull that chart out if I can. I hope that's okay with your viewers here. Oh, it's down 87 now, right? So my big perspective on this, and it's been a long journey. I take that, but for me, as I said a long time ago, I say this is Elliot Waves. It's back to you either believe in it or you don't, and you can say call it's not worth doing. But I tend to like it because I think it's based on people's emotions. So what I see is that we had that real top in the B wave here, which was back in August of 2020. This top didn't go as far. This was actually wave one. This is the wave two that got everybody back on the wrong side of as exactly as it's supposed to do, get people on the wrong side, and people calling for 2,000, 3,000 again, in terms of gold price. And then it reversed on the last month, and it's continuing down now. I see a strong decline, and I see that decline down to around the 890 to 960, so 890, 960. And I do that because of extension levels, Fibonacci extensions. I do that because of retracements, Fibonacci retracements, and because of this structure. And it tells me we need to go back to this kind of, to the demand zone. And that gives us that trading range. Why? Because when you are in a liquid environment, when money is being pulled away, you need liquidity. And the reason why we always been told you need to buy gold into crisis is because you can sell your gold to get liquidity. And if you need liquidity, you need to sell the gold to do that. That's where it actually, perform its finest task is to be getting sold to get liquidity you can use for food and for oil or for whatever it is that you need to buy. Mm-hmm. So this about as an investment. It is a good investment in the inflationary period, and that's where what we need to see. We need to get the real economic inflation going, and I think we're going to get into the next cycle of that. But again, we are just 8-9 months down the road, because I think that the crash we're going to see in gold from here is going to be quite strong. I'm going to put up a new video on the Zeberg report, which actually will look into this, and it'll be for free, so people can go check it out.
Mm-hmm. So it's not necessarily, let's say, long term that you're overly bearish on gold, or you think that gold is a dead asset. You think that once we get that crash, there are going to be some amazing deals to be had, and that is going to be a place that you yourself want to be, right?
This is the blue arrow here. And I think the real price of gold will be back when we get to that point here. That will be the time where to get in. And the last time around we had stagflation. It's not now. So we don't, it's not now, because gold would not perform badly, and GDX minus index would not perform as badly if we had real stagflation. But the last time we had that was 1977 to 1980, and gold was at 200 something and went up to 850 or something like that. So like 5-6 times up in a matter of 1 or 2 years, 2 years or something like that. And I think this time around, with the more leverage we got, with the more debt we got, with everything, balance sheet on the Fed and so on, it'll do 5 times, no sweat. It'll do 10 times no sweat. So that means that we are, if it hits the 900, let's say, you can easily see 10,000 2 years down the road, 3 years down the road. And why is that? Because when they get back in the next time, they're going to unleash the real genie, the real inflation, stagflation. And that will be, something that they can't get rid of for a certain amount of time. And that's the environment where you do not want bonds because inflation is high. You do not want equities because the cost is and the economy is not doing well. So you don't want to be in bonds. You don't want to be in equities. You want to be in commodities. You want to be in gold and silver. So that's where it is. And that will be a 2-3 years kind of, time phase or zone that where I think there'll be fantastic investments. And that's where that's the point I'm getting really ready for, also for the subscribers to embrace that moment and say, okay, if we're going to get that deflationary bust, well, there's nothing so bad, it's not good for something, and that is really to get ready for that moment in time, and then there. I mean, because if you do not see this, if you've been expecting 3,000 on gold since it was here, and it went up like this and then went down again, do you dare actually to buy it here? You do if you were expecting it, but if you expected it to move up, you wouldn't dare. Mm-hmm. So that's actually why I want us, keep this very clean and say, okay, I think this is the right pattern. This is how it's going to unfold. And I can see the reason for that, but I wouldn't dare to buy gold right now because I wouldn't see it, standing in front of a crash like this. But if I expected that crash, and I could then say, down the road, if it hits 800, 900, 1,000, I would start, adding to the portfolio. That's probably it's probably what we'll be feeling better, from a kind of investments perspective, right?
Mm-hmm. So how does energy play into your whole thesis as well, Henrik? The vast majority of the world still really relies on oil and gas to power and move everyday life. But do you think that, the demand destruction that comes from that deflationary crash really hits oil as well?
Yeah, everything. It will do just like what we saw. I mean, again, it's because we're standing in one, outlier here in terms of, the observation we got in terms of oil has just been up and all that. And yes, it is. We're going to see that because when we see the buildup of capacity in terms of, from suppliers and manufacturers around the world, and all of a sudden this demand is waning, and it's coming down again, and it's actually maybe you pull forward all this demand and investments, and all of a sudden you also got the Fed coming out and being hawkish, and you got a dollar coming up. Well, then you're going to see the consumption is going to come down, and that's going to bring oil and commodities down. And my charts on the commodities are, I can see them moving up, and I can see natural gas, and we had some great moves up in corn that just hit this what I call the B wave. So you had the high here back in 2011 or something, you had the move down, and then this new move up. Everybody thinks that's the new where we go to infinity, but it's actually the A, B, and a C. You miss the final C wave. Mm-hmm. So I think we have seen the B wave peak in a lot of commodities and in oil and in energy, and we're going to see it come down crashing again, because wherever you got an excess demand, you'll see supply trying to ramp up, and if it ramps up as demand rolls over, well, then you have the perfect setup for deflation, and that comes also with energy. Are there factors now that can influence and push it out in the future? Yes, definitely. But the more that we see that, the more we are going to think, okay, how can we, surpass that? How can we get, if it's not Russian gas we want, what can we do else? And we will find our ways to get the energy that we need. If price moves up enough, we'll figure it out. That's human nature, right? So yes, I think it's going to come down hard, and it's going to be just like it'll be a replay of the 2007, 2009, but this time a lot worse in terms of some of the in terms of a lot of assets that are going to be hit a lot harder because they're simply too highly valued and will become even more in the blow-off top.
Mm-hmm. It seems that looking out further, like you say, with gold appreciating like you're forecasting from that 860 to 960 level, it seems like the destruction of the dollar at that point really drives a lot of these things higher. So where do you see the standing of the dollar going forward here? Is this real move that in some ways Russia started and showed the world that the world wants to move away from dollars? Is that a big part of a big part of your thesis? And are we heading towards that monetary reset in that timeline?
So first of all, a monetary reset will always happen during an inflationary phase. So if during a deflation, it's just free. It just offers you a free opportunity for a free lunch, which means that you can start printing money and there's no inflation. It's nice. So you can bring out all the good for people, but there's no, you don't need to pay for it. So it will happen. But when you really need a new monetary reset will be when inflation starts to run hot. I think Russia is trying to do what it can to challenge the dollar hegemony. It will not be able to. So when the last time around, when the dollar really became the one and only the reserve currency of the world, it was because the U.S. had a large part of the trade of the world and it had the 50% of the the gold reserves in the world, and so on and so forth. So the U.S. was the one and only superpower. Russia is not that. I mean, Russia's trade is like nothing, and they got a lot of commodities, right? But we could figure out other ways to find those commodities, and nobody wants to be dependent on Russia. So I think Putin is trying to play that game, and there were two, I think, with Chinese generals back in the 90s that said the only way we can get we can compete with the US or actually beat the US will be if we can do that through our army or military for the next 30 to 50 years. We'll have to do it by hitting the dollar or getting on to that dollar hegemony. Russia will not be able to do it, but yes, it is a move that I'm sure Putin would have liked the Chinese to join in on, but there are other ways to do that. So is that part of it? I think that when we get down to the point, and when we reach that point where stagflation is surging, and this will be when we reach this part of on gold here. So gold is surging because of stagflation. The dollar is crashing. What we see then is that inflation will then be surging in a lot of countries around the world, because that a lot of commodities will be driven to much higher highs. So inflation will be surging, and everybody will be looking at the dollar and say, hey, that's because you're weakening your dollar, and that's so we do not want you to export your inflation to us. At that point, at some point, there will be the General de Gaulle kind of moment where as France comes in and say, hey, we don't like this, or Europe comes in and say we actually think we need to do something about this hegemony because we can't have that. So that's when there's going to be some serious business around that, and that's where I think the monetary reset will also be about. So getting bad debt away, and let's say that they will do this simply just have a debt jubilee, and they will make that kind of monetary reset. And so will that be driven by Russia and China? No, I don't think so. I think it'll be driven by the inflation that's going to move up. But what Putin tries to do here is absolutely try to challenge that. It will not succeed. And even if China moved in, it will not succeed, because I think that we in Europe and in the US standing together will still be a stronger coalition there in terms of defending the dollar, which is a good thing for both Europe and the US today. But down the road, we will need a more balanced reserve currency of the world, and that will probably have the real components of crypto, meaning that there will be some crypto elements to it. Let's not get into that today, but of course there will be also be more balanced in terms of it's not just a dollar. It will probably be a basket of something, and maybe driven by a blockchain or whatever. But we are some years away from that, and that we are looking then past the blow off top and the deflationary bust, and then even into that, when we start to see inflation and stagflation take off. Yes, I think we're going to have it because it's the only way to get out of the debt we have, and also to solve the credibility issues we're going to see down the road, also with the dollar.
Excellent, Henrik. Well, I really appreciate you walking us through really every piece of your thesis here. Is there anything else you'd like to touch on before we wrap up?
No, I think we're good. We came across a lot, so thank you for that. And if you want to follow, then the Zeberg report is where I'm keeping people up to date with this thesis. It hasn't changed too much actually over the years, and it's still seeing this deflationary bust, but of course there's some timing elements to it, and also there are, if correct, there are some fantastic buying opportunities down the road.
Mm-hmm. Absolutely. Of course, your website is thezebergreport.com, and on Twitter, you're at Henrik Zeberg. Henrik, thanks so much for your time today.
Thank you very much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.